And good morning and welcome to Money Matters. We are officially live. My name is Nev and we're broadcasting straight out of New England in United States only on onedealaway.com. And today is Monday, so happy Monday to everybody watching this. It is July 13th and we have a very important show. We're going to be overseeing what's going on in the market just to get an understanding of sort of what's been happening and where are we heading. So we do have some interesting components to discuss and talk about. And one of those things is going to be talking about sort of that whole Trump threat to Hong Kong. Can it or can it not influence what will happen with the peg or not? So we're going to be talking about that. I do have a very important and interesting Samsung Galaxy leak, and I will share with you what that is. I thought it was really interesting and kind of cool. But I don't know. You let me know what you think when you see it. We're going to be talking and discussing very briefly about the fintech ecosystem and what's happening there. Of course, we are going to be talking about the economy as a whole and risk. So we're going to be discussing risk and how do you take risk or don't take risk or account for risk when you are investing your money. We're going to be talking about the banks and the world of pain that they might or might not be facing for the second quarter. And that should be the episode for today. So, as you can see, it is jam packed with information that you need to take care of your money because your money indeed matters. Let's do this. And good morning, good morning, good morning. Welcome to onedealaway.com. I want to welcome everybody watching this live. As always, we're going to go into Q&A at the end of the show. Everybody else watching on YouTube, welcome as well. Do me a favor, hit the subscribe button and the bell button so you get notified when new episode shows up, which is basically every day because we do this every day at 7 a.m. I know it is early, but it's important to do the most important things early in the morning, and that is educate yourself. Because when you do it early in the morning, you have an entire day to actually implement. And that is the key to success. Now, all right, let's go in and talk about it. Let's go start with Samsung because it is kind of exciting news. As you can see, Samsung Galaxy Z Flip 5G appears in a new video leak. And, flip phones are coming back, y'all. But as you can see, it very much looks like a normal sort of smartphone that we are used to, except it flips. And it's kind of cool that they're flipping and breaking the screen in half. And yet, apparently, it all works together. We don't have much more information about it other than this. So I know it was a bit of a video leak, but I will show you what the leak is. Hold on, let me see. Hopefully you can see this. And as you can see, it's basically, you know, smartphone just like you're used to it, except it flips. And so it's a half a size when you put it in a pocket, hopefully twice the thickness, perhaps, I don't know. But it is definitely an interesting thing to consider. And as you can see, apparently or allegedly, that screen is not impacted at all. So there you go. That's one of the things that you can look forward to if you are a tech aficionado and you get into the new phones every time they roll out. Another piece that we talked about only a few days ago is I was having a discussion or sharing with you with the fact that vast majority of the jobs are not coming in, and we were talking about rose. And I had actually, thank you very much to individual that I believe it was the interior designer, a follower that has shared the pronunciation because I was like, is it Rosie? Is it Rose? Is it how do you say it? And she corrected me and said it's rosé, like wine. And I'm like, okay, I like that. So Rose, the robot that serves the hotel guests, right? We talked about that. And I was saying how robots are really going to come in and going to replace more and more and more and more of those things, and how many of those jobs are not coming back. And I talked about the importance of retraining oneself for different kind of jobs, and expanding, constantly expanding your skills, your abilities in what you do. And so I am always studying. As you can see, I am here live, and we're learning together about markets and about money and what can we do to improve our well-being and create more income to come our way, because more income is better than one income. Wouldn't you agree? I personally think that that's the key, because when I have 10 that are more or less equally paying, and I can live off of one or two, that's an amazing world. It's an amazing day, because even if one dries up, it's no big deal. But when you rely on one income and that one dries up and it goes away, it is a huge problem. So that is what I am always, always, always telling my clients and my students to start working on and focus on. And that is something that I am always focusing on. And, I always tell folks, I am learning just as much as you are. I'm always doing stuff. I'm always learning. I'm always looking for ways to improve and sharpen my skills, my saw, so to speak. So when it goes out to cutting, meaning making money, preserving my wealth, I am smarter every single day. And you want to be too. And that's why you hear Money Matters. Here is another article that we are seeing, and this is coming out of Tyson. Now, Tyson, if you don't know, if you're from not from United States, is one of the largest meat manufacturing. Well, not manufacturing, but sort of a producer, right? Where they go in and take the cows and the chickens, and they basically make them into the products that we see on the market. And they're basically saying that, yeah, they would prefer to have humans, but machines are much more efficient. And yeah, so they are basically, the food processing plant in Tyson is turning to robot butchers, as you can see over here. And there is basically zero humans that are producing this stuff. Now, this is what it looked like in the past. All right. Where you had a human, a human, a human, a human, a human, and they were doing all these different things. But now this is basically what it looks like. And if you think that this is just one place, again, we talked about Rose, and we're talking about the robo butchers. Literally, they're butchers, they're robots. Their basically sole job is to cut the meat. And you now, instead of having, I don't know, 50 people, 100 people, 1,000 people in a factory to, get the meat processed and packaged, now you get all of these machines, and you might have one or two technicians that understand technology, hint, hint, that are able to go in and operate this stuff. So you want to definitely want to need to absolutely need to understand how money works, how technology works, because those are the two key things that I firmly believe are the future. They have been here. They are going to continue. We're not going back to the good old times, as good as they were. They were also old. We're going into great new times. But right now, in the transition period, which is where we are right now, which is what we're experiencing right now, we are going to experience a whole lot of pain. Talking about the new and exciting, here is some information about the fintech ecosystem. And as you can see, it is huge, it is vast, and it has all kinds of things. So you have robo advisors and personal finance advisors that exist and have been created over and over and over again. And I think that eventually these are going to get bought up and basically collapse into the mergers and acquisitions. There's going to be only a few. But right now, it's so early in the stage of all this stuff that so many are popping out there. Then we have the RegTechs, which is basically the regulation technology that is coming in within the financial industry. Digital banks and banking software providers. So you have all these providers that are going to help out with how do you get into the digital bank, because most of us are not going into physical banks, walking into things. And this was a trend prior to COVID. Please understand that. But now with COVID, the banks don't want you there. You don't want to be there. So we're seeing the drive-throughs are picking up yet again, and more and more banks are actually, if they don't have online services, they're starting to lose customers. So they're jumping into the online services as much as possible. Then we have payments and remittance, and that's sort of the whole how do you pay people? And of course, it started with PayPal, probably the most popular. But then we have the Apple Pay, the Venmo, the Cash Pay, the Stripes, the all kinds of different things that are coming in. Then we have alternative finance, and these are different ways that non-banks are starting to get into the banking industry, into the finance industry. It's like Lending Club and Lendio, and it's these like peer-to-peer lending platforms that are starting to develop. And there are also other companies that are going to give you an ability to get into the cash or to lend the cash out. Then we have InsurTech, and it's basically insurance company that is going into the technology. And we're seeing, Lemonade, for example, comes to mind, and it's listed here as one of the places. And it's this new way to get insurance that is basically more on the tech and the robot side. And I want to say it's like $1 or $5 a month or something like that. It's something super low that you're able to insure all of your property as a renter, for example. So they're serving purposes for sure. Then we have digital identity verification platforms that are starting to develop, and of course, blockchain, decentralized ledger, and and they call it and Bitcoin. I would say and crypto. Uh, so it was adorable. They are still learning because they say blockchain, DLT, and Bitcoin, and I'm like, no, 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 no. And then of course list Ripple. Anyways, yes, that is also part of the fintech ecosystem. And as you can see, when you look at all of this stuff, right? You look at the robo advisors, the red tech, the digital banks, the insurtech, alternative finance, payment systems, and all of that stuff. Look how big they are. Look how many different logos they have there. And then you come to blockchain and digital identity, and there is only few. Now, the reason for that is because that is the newest, absolute newest place of technology that is being developing with our money. And I personally believe that this piece right over here is going to take over all of this stuff. And a lot of these are going to start going into this stuff. Again, just my personal opinion, not a financial advice, as always. And they will basically have a full report. This is out of Business Insider. They have a full report of, if you would like to go and get and read it, it's about $500 to purchase it. That's right, it is not free. And the Business Insider, on one hand, touts as a news delivering agency. However, vast majority of their content is paid, is subscription, and you will have to invest substantial amount of money to get into it. Anyways, they're basically have the chart over here. So this is this chart that I just pulled up, and you can see the demand for all mobile banking features and how important would the following mobile banking features be if you were choosing a bank. Extremely important show. So instant transfers, fingerprint login, order replacement card, Apple Pay, turn card on off, mobile peer-to-peer send, set travel alert, passcode logins, and you can see that there is this whole slew of things of what people are looking for to be able to go into their the bank. Some of them are even saying smart speaker banking, right? A voice banking app, chatbot in bank app. Of course, these are much lower down the sort of the list of requirements, but the instant transfer is hugely important to folks. And so it is something to pay attention to. Again, this one is not really a report. It's really the sales page to the full report of $500. Now, we did talk about the Trump administration threatening to hurt Hong Kong dollar peg, and it's saying it's not going to work. And they're basically saying that an outside country cannot necessarily control what the inside of the country does. And the Hong Kong peg is set between 7.75 and 7.85. That's sort of the band where it trades. And when it hits a band on the upper or the lower end of things, then the Hong Kong Monetary Authority basically intervenes by selling or buying the currency. In the crypto world, we call that burning, but they don't burn it in the traditional way. They actually sell or buy. So that's kind of how they do it. And they're basically saying that they are the autonomy that has an ability to design its own monetary regime, including exchange rate policy. An outsider cannot necessarily control that stuff. And that they're saying that, hey, there's this 1992 act, that there's a clause which states that the U.S. will continue to allow U.S. dollar to be freely exchanged with the Hong Kong dollar. But what they forget to mention is that we do have a president that has an ability to put in an executive order. And let me tell you, none of them have been shy in 2020 to dole out executive order after executive order after executive order and change all kinds of laws and books. So I don't know why people are holding on to the old laws. They were like, well, there was this thing. And I'm like, yeah, they also have a power of executive order and they just cut it and get rid of it. But there goes that. They're also arguing that the Chinese territory holds 440 billion in dollars in dollar denominated foreign currency reserves, double the size of the city's entire monetary base, is what they're saying. But again, if they're not able to buy or sell the dollars and the dollar becomes very, very needed, very much needed, then that becomes very much a problem for them because, again, you have to buy and sell. And if you can't do that, then you hit the trouble. And all of that comes from the swap lines. Demand for the Hong Kong dollar has surged this year, and the Hong Kong Monetary Authority intervened in the Hong Kong dollar peg at least 23 times since June 5th. So, in what? 1 month, they had to intervene. That's basically every day that the bank is open, they have to intervene in the peg to keep it. So, it's definitely going to be something that is very, very interesting, but it is going to be highly curious to see who does what and how the game is played. And I don't think either one of the countries is going to kind of, back out if it truly begins and rolls out. Both parties, I want to say, are equally stubborn, and it is going to be tit for tat for sure. Here we go. The U.S. Bank could be setting up for their worst quarter in more than a decade as loan loss provisions and the pandemic are set to wreak havoc on bottom lines. Next week, many of the too big to fail banks are set to report earnings and are likely going to show a drop in consumer spending, and higher loan prices were not offset by better trading gains. We've got a full 3 months of the pandemic coming through the numbers now. The first quarter was rough, but it really only reflected a couple weeks in March, right? And so you can see that black is the loan loss provisions, is what the chart is showing, and you can see that the black one is the fourth quarter of 2019. First quarter of 2020 is right here, and you can see it is substantially up. And this is the estimate. So, estimate for West Fargo for second quarter, not a whole lot higher. Bank of America a little bit higher, Citigroup allegedly lower, and then JP Morgan slightly higher. So I don't know if that is going to be accurate. I think that that might be wrong. I think that these light blues are going to be much higher, but what the heck do I know? We'll see. While many banking stocks have recovered somewhat, the S&P 500 Financials Index is still down 26% since last December. Data compiled by Bloomberg shows that U.S. investment-grade corporate bond issuance doubled in second quarter to $757.7 billion dollars, and high-yield issuance was up 61% to 131.1 billion dollars. And you can see that they have been definitely getting a nice bump when it comes to trading. Low rates continue to entice buyers. Spread between the lenders, they're talking about the mortgage here. Spreads between the lenders sell their loans for what they charge borrowers are the highest they have been since 2008. I'm going to pause this. We're going to read this again because this is very important for you to understand. Because a lot of times we as consumers, we think we're getting a great deal, but we're not. Banks are structured in such a way, traditional finance is structured in such a way that the banks and financial institutions always win. Always win. Let's read it again. Spreads between what lenders sell their loans for and what they charge borrowers are at their highest they have been since 2008. Now, spread is basically if I buy uh, if I say borrow $100 at zero interest, right? But I lend out that $100 at 5% interest, my spread is 5%. And so even though they're promising and saying, well, it's 3% for you right now, but guess what, y'all? If we go back into November of 2019, where the mortgage rates were, let's say, 4%, the bank's borrowing was at about 2.5% or so. Or 2 and 3 quarters, maybe even. I don't remember. It's been so crazy. I can't keep all the numbers in. So their spread was much smaller because at 4%, and if you borrow at 2.5 or 2 and 3 quarters, you only have 1.5 or 1.25 spread between what you borrow and what you're able to lend at. Now banks are getting zero. Okay, I know it's like zero and to a quarter, but I assure you, these big banks are getting it at a zero, and some of them might under the table. We don't know this. I don't have a proof, but might under the table get negative interest rate, meaning they get paid to borrow money. And of course, with all the bonds and equities and all, the Fed is definitely propping them more than it's propping us. I can assure you of that one. So they get it, let's say at zero, but they lend it at 3%. Well, what is their spread? It's 3%. It's twice what they had a quarter or 2 quarters ago. So you need to understand that component as well. And that is really, really important and key component. And then finally, the important aspect of paying attention to what's going on in markets, and when you are implementing your investment strategy and managing your portfolio, you got to think about the risk. So this article is very interesting. Of course, it focuses on the stonks, as they call it, the stock market, but this some of these components here are important regardless of what you're investing in. The near vertical price acceleration in the markets has been a historical hallmark of late stage cycle advances, also known as melt up phase. I believe they're arguing that's where we are. When markets get more than two standard deviations above their long term moving average, reversion to the mean have tended to follow shortly after that. Meaning, when it goes up more than it should, it typically comes back down to the mean. Now, this, what you're seeing here, is saying that was in January of 2020, 6 months ago. Here is where we are today. This is as of 10th of July, that you're looking at this stuff. And the price of the Nasdaq gone parabolic. This time it is pushing 3 standard deviations off of the 200 daily moving average. Okay, you can see it right here how it actually has gone, and they're saying this is nuts. It's fundamentally detached, and the divergence is particularly notable when you consider the economic and fundamental differences between now and then. Nasdaq price 9,100 whatever. This is in early January of 2020, when none of the pandemic insanity was happening, and now in July is 10,500 something, where all these things are melting left, right, and sideways. And this is a 15% increase since January. Okay. Now you can of course see that the GDP is down almost 11%. Unemployment rate is up. Uh, Continuing claims for the unemployment is up. Debt to GDP ratio up, federal funds down, 10-year rate down, 2020 earnings estimate down, like whopping 43%, 2021 earning estimate down almost 15%. As you can see, it doesn't make sense. It does not make sense, and the divergence between the Nasdaq and the S&P 500 index is emulating the late 1990s. The horizontal red line is where the ratio was last Friday, just for perspective. So this red line that you see it right here, and this is basically saying that this hasn't been seen since the 1990s. Remember late 90s? We had the 2000 melt, okay? So they're saying very, very, very bubblicious. But then again, we have been in bubblicious territory for a very long time now, y'all. And yet, all this printing, all this printing, all this printing is going to go on up. I think that the goal and the point here is that it cannot go up for forever. And I think we're just trying to get the pain, postponed. And I remember the conversation back in the 2008. They were like kicking the can down the road. So many people have said it, and so it always brings me back to that. Optimus in Nasdaq 100 has also reached a level of exuberance seen only once previously in 25 years. Again, the late 1990s, and you can see the optimism index 3-month average, and it is very, very high. So as you can see, it hasn't been at this level, but 1990s was definitely higher. Uh, we have begun the profit-taking process within our most profitable names: Apple, Microsoft, Netflix, Amazon, Costco, PG, and Communications and Technology ETF. Now they're saying profits. They're not selling the entire position, but they're reducing the position that they have and getting some cash out. Several key labels intensive industries: education, lodging, entertainment, restaurant, travel, retail, non-restaurant, real estate, and that kind of stuff, face existential threat through their core. They simply cannot survive the conditions they face. And this is basically when it's starting to, this is the economic index when the V starts to roll over. And you can see the consult index, um, consumer sentiment, and we are sort of hitting the low, and we've kind of gone back up into the June, but as you can see, it's starting to kind of come back down. When the market historically becomes detached from underlying fundamentals, revisions tend to happen very quickly. It seems like we have dodged a bullet, yet a look under the surface reveals a much sicker market. The relative performance chart below, this chart right here, shows that while the S&P 500 is still down 1.8%, the big tech index, the top 8 stocks in the Nasdaq 100 by market cap, is up by astonishing almost 49% year to date. And you can kind of see that what's going on. And then of course you have the FANG stocks, and that's the blue line. And as you can see, that's even crazier. That's even crazier, even smaller market, but even crazier. The table below shows that these 8 stocks represent 8 trillion in market cap, which is 29% of the market cap of the S&P 500 to $27.3 trillion dollars. And they have this, chart, table right here, and you can see the big tech, and of course it is Apple, Microsoft, Amazon, Google, Google twice, Facebook, Tesla, Nvidia, as sort of the biggest ones that are holding stuff. The current rally is very narrow, historically dependent on less than 2% of S&P 500 member stocks. At this juncture, one of two things can happen with the big tech S&P 500 ratio, which is less overbought. Stocks can go, stocks other than big tech can rise faster than big tech, or big tech can fall. And based off of what we know about the economy, have a very hard time seeing that everything else is going to rise. I think what will happen is that the big tech will kind of have to fall to close that gap. Again, not financial advice. I could be wrong, but that's just my thinking. Wherever there seems to be like can't lose bet in the financial markets, you're essentially guaranteed to lose money. Sentiment Trader this past week, the CNN fear and greed proxy, has turned down recently from very high readings. While this does not suggest stocks will crash, it does indicate over the next few weeks returns will be likely more muted with increased volatility. And then one would want to say, hey, jump in and trade the volatility, but you can't because it has been delisted. And now, to finish in the article, we're going to talk about what our job as investors is, and that is to focus on risk. Our job as investors is to navigate the waters within which we currently sail, not the waters we think we will sail later. This is very important. So, what they're saying is don't just be thinking of, well, this is what's going to happen in 2021, so I'm going to get it now. No, 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 no. There's still a long period of time, 6 months to be exact, between now and then. And you got to think through what is going on right now while preparing for what you think might come. Higher returns come from the management of risk rather than attempting to create returns by chasing markets. Now, what he's basically saying is that I have been guided by four principles for decision making. First, the only certainty is that there is no certainty. I think we can all agree to that. Second, every decision as a consequence is a matter of weighing probabilities. So every decision has another consequence, which has another decision, which has another decision. So everything has consequences. Do it, don't do it, everything has consequence. And you have to understand that and weigh the probabilities of which one is more likely than not to occur. And then you go with that one and then you adjust from there. Third, despite uncertainty, we must decide and we must act. That's the piece that I was just saying. You decide, okay, I have these options. What is the most probable option that is going to occur? And then go in down that line of thinking. And then you still have to make some sort of action. Of course, not taking action is also taking an action. It's an inactive one, but an action nonetheless that also has consequences down the line. And lastly, we need to judge decisions not only on the results, but also on how we made them. So this is a key component that I really, really appreciate and like. And it's not just sort of to judge a decision whether you made money or not made money, but also how did you come to the conclusion and why? What did you see? What did you not see? What did you make a decision that you shouldn't? And why did you think what you thought? Because when you start doing those things, that's when you actually start deep diving into your processing, into your learning, and gives you an ability to massively improve your potential to make a better decision next time. And honestly, that is the best thing that you can do is to take an action, learn something, take an action, follow through on it, and then see did it do or didn't do what you thought it was going to do, and what was the thinking behind it? What decision led to next decision, led to next decision that brought you here? Because when you can understand those components and break them down and go back in time and really look at it, you can start breaking down where you made an error and why, so that next time similar situation occurs, you will be much smarter to make a much better decision that is more likely than the previous time to give you intended results. You will always get results. You might not get results you wanted to begin with, but they're valid nonetheless. And if you break them down in the process that we just talked about, it is going to help you a great deal. So there you go. I hope you have enjoyed it. I hope you have learned something. If you're watching this on YouTube, do me a huge favor, hit the thumbs up, hit the subscribe button and the bell button, and you'll get notified every time the show goes live on YouTube. Well, the replay, so to speak. And thank you for joining me, for everybody joining me on onedealaway.com live. We're going to go into the chat session right now. And until next time, stay forever money blessed. And do remember, you are only one deal away.